Good morning and welcome to the second day of our joint ECB and SRB event, The Test of Time, Banking Union a Decade On. Yesterday we took stock of the banking union, drilling down into the next steps for crisis management and the resolution framework. And we also had some interesting insights into what's coming next, what the future of banking might be. Today we shift our focus from the regulators to the banking sector itself, of course the heart of the banking union. First, we will hear insights from KBC Chief Executive Officer Johan Thijs, and then turn to a panel on how resilient European banks are. As yesterday, we invite you to comment and ask questions via the Mentimeter tool, and you can see the details of how to do that on your screens. With that, let's get started. Please welcome KBC's Johan Thijs, and don't forget to send in your questions for him. Mr. Thijs.
So, good morning, Mrs. Koenig, Mr. Andrea, ladies and gentlemen. First of all, thank you very much for having me here. It's a great honor, great pleasure. Not every day an occasion to speak to such a large audience. I was not aware that 3,000 people are watching us, so I'm pretty stressed. But anyway, the financial crisis and its wake, the European sovereign debt crisis, clearly illustrated the major impact of the financial services industry on the economy, and the reflex of member states to protect national interests and their own banks confronted us with the fact that the European market cannot do without an advanced integration of its financial sector. No doubt about that. The progress that has been made in creating a European banking union since 2012 is positive, and it's resulted in more robust, healthy and stable financial sector in Europe. Our recent experience with the pandemic has been a case in point, and one might say that is due to a massive intervention from public authorities or central banks, true, but still, in this case, the commercial banks were part of the solution, whereas in 2008, the commercial banks were part of the problem. Now, we should not take this accomplishment lightly, because implementing a common supervisory and resolution framework for the biggest financial institutions in 19 countries in the Eurozone, each with their own structure, each with their own culture, each with their own operational performance, is quite an achievement. So congratulations. It was also a highly needed achievement, if I may add, because I'm pretty well placed to admit that in the years leading to the financial crisis, banks, commercial banks, have made serious mistakes. As I said, there's no doubt that the ECB and the SRB have done an excellent and thorough job. We cannot, however, stay blind to the fact that a lot of work remains still to be done to mitigate several existing flaws, and we should have ambition to complete the work. Or to say it with the quote of a book, let's move from good to great. So let me share with you some critical reflections, and I do apologize in advance. But the goal of the banking union is to create a robust and resilient European financial institution by implementing a comprehensive package of risk reduction measures. This should safeguard national governments' budgets from being jeopardized by a potential failure of too big to fail banks. Today, both the single supervisory mechanism and the single resolution mechanism contribute to this goal of creating what is called a level playing field in a stable financial sector. In their approach, both ECB and SRB do their utmost best to treat all financial institutions equally, starting from the concept of a level playing field. Now, in its setup, this is a clearly logical step, and both the ECB and the SRB are applying this strictly to avoid, I think, any legal mistakes. Because, let's face it, Europe is quite complex. And I fully understand that position. But what's the definition of a level playing field? And can that interpretation of level playing field vary upon circumstances? Next to that, and I often hear that, the downside of constantly using the so-called benchmark as the reference for all or for some policies of the industry is putting the bar at the level of the average of the industry. I would even say it puts the bar at the level of the weakest banks. And in my opinion, the approach pays insufficient attention to, as I would call them, positive outliers, or if you want to, negative outliers. So let me illustrate what I say to that, and let me use a quite controversial example. Let me refer to the dividend ban for all banks in the early days of the COVID pandemic. One could argue this to be justified as a precautionary measure because it has safeguarded the stability of the financial industry during a very stressed period of the economy. And I fully agree, it has worked out. But was it really necessary? And for me, an easy one. Now to say with hindsight, no, perhaps we could have done differently. Because, let's face it, there were some well-capitalized, highly liquid banks, profitable banks, and perhaps the measure which we have taken has caused, in that perspective, some hampering of the free market approach. And for sure, it has definitely not supported any potential consolidation of the financial industry in the European domain. Consolidation which is so strongly argued for by the ECB. So it's a quid pro quo. In my view, to strengthen the European banking landscape, once a certain level of stability has been reached, and I repeat, once that level of stability has been reached, a common denominator for a sector benchmark approach applied by a supervisor is not necessarily the right way forward. If a business model proves to be superior to another, if an institution shows to be better performing than others, this should perhaps be more recognized. And the opposite is true as well. If it do worse, it should be recognized as well. And let's face it, in putting everything at the level of the benchmark, it might create a significant concentration risk as well. Now, centralized prudential supervision has reshaped and harmonized how the Eurozone significant banking institutions are supervised and has further aligned the application of EU's single rule book. At the same time, centralized recovery and resolution planning, as well as dedicated European Eurozone level resolution fund, provide confidence that a crisis in a systemic bank can be managed efficiently and without cost to taxpayers. So notwithstanding the centralized supervision at the European level, national regulators and supervisors continue to play an important role, both in sharing and shaping regulation as well in day-to-day supervision, as these national authorities have an understandable national tendency to give priority to national interest. This implies that on the field, the banking union is not yet as much as a reality as one could hope for. Ring fencing is still alive and kicking, and you could say it's a bit more subtle than it was before, for good reasons. Now, regulation is still interpreted differently across EU member states, resulting in different practices in day-to-day supervision across the EU. Now, we as commercial banks notice a clear difference in the interpretation of regulation between different member states. Being CEO of a group which is across Europe under SSM, NOSM as SSM countries, we clearly notice that difference. And a certain discrepancy between non-SSM member states is understandable to a certain extent. But even within SSM countries, we can't help notice that European supervisors turns a blind eye when it comes to aligning the implementation of European rules. And we wonder why. Although we agree that robust and healthy banks are necessary to create a safe financial system that can absorb shocks and crises, we must always keep in mind that we act in a competitive global market and that providing financial services to the European economy should be both convenient and acceptable prices for our customers, because that's the reason why we are here. We are not here for us. We are not here for us supervisors. We are not here for us commercial banks. Now, a strong EU economy requires healthy and competitive banks, and that's where it starts with. This is something that should be considered more in regulation, more in supervision, more by us. I have a clear message in this respect. Please to cut the red tape. The enormous complexity and disproportionate amount of information required by the supervisor comes at a significant cost for the banks, probably for you as well, and therefore the overall economy is hampered as fact as well. It is of utmost importance that this money is well spent. And to illustrate a little bit, let me give you a couple of examples. The first example, I would like to refer to time and energy consuming fit and proper process preceding the nomination, for instance, of a director to the supervisory board or a member to the executive committee or whatever, member and an appointment of a senior general manager in very specific roles. This process is lasting months. And I'm not speaking 1 or 2 months, I'm speaking about a multiple of that number. And in the meanwhile, those positions are vacant, and we are waiting. Same can be said about the approval process of acquisitions. And next to the very cumbersome and sometimes very painful administrative process which goes along with that approval process, the throughput time of such an approval process is very long, and very long. Now, I'm the first one, and I think all my colleagues will follow, to recognize the complexity of such an approval and the importance of doing it right. I fully agree. But does it need to take so much time? Seriously? We need to be aware that the acquired company, the acquired assets, the acquired liabilities, the employees in that acquired entity are during the long approval process subject to scrutiny by the markets, scrutiny by the competition. And this leads to financial impact for the acquirer. And I know one could say, so be it, it's your problem. I agree. But it also may lead to destabilization of the acquired entity. And that's no longer our problem, but it is our problem, you included. Another case in point, KBC is required to deliver 5,880 reports and templates to the authorities, supervisory authorities. Let me repeat, almost 6,000 reports. It was 4,700 3 years ago, so it's an increase of 20%, which is quite a lot, even if the number 4,700 was a lot in itself. Now, this enormous workload implies a significant financial cost. And to illustrate, to create all those reports, I mean, the system in itself, not the generation of every single report of every single template, KBC has set up a project with a total investment cost of 200 million euro. And counting. Now, interesting to note that in times of crisis, we have experienced a couple of them in the recent past, we did not use a lot of those reports. And the same is true for the supervisors. They only used a limited number of those reports. And I would say, I could count them on one hand, the fingers of one hand, perhaps the fingers of 2 hands. But still, why do we need to issue all those reports? What concerns me even more, that is a potential next step. The supervisory authorities may request tomorrow access to the underlying database, which, triggers an interesting point of discussion. But it allows them for sure to distill out of that data their own reports and present them, or at least the conclusions derived from those reports or those data analysis to us. And this would, what I would call, this kind of reporting, I would call it direct reporting. This would create a very strange reporting stranglehold. Because, the outcome and interpretation of any kind of report, of any kind of template, is strongly depending on the knowledge of the underlying businesses, and therefore is not necessarily unique. This would often lead to what one could call reconciliation problems with us. And as a consequence, a lot of extra labor to be done. So I'm not necessarily a fan. Anyway, it would generate potentially for both sides an extra cost. And what's the added value? Now, the fact that different authorities require the same or different information without proper coordination makes a bank often the object of an international and an institutional ping-pong game. ECB and SRB sometimes take opposite stances on the same problem, leaving banks in limbo. how to deal with the situation. Being the CEO of a group of 45,000 employees, I sometimes wonder if top managers, me included, knows what's really going on the lower levels, at the lower levels of the organization. When people in the big organization, well-intended, execute tasks within the framework set by top management, the outcome and definitely the way how the work is delivered may differ from the original intent. And I'm still speaking about my own institution. But why would it be different at supervisory authorities? Why would it be different in supervisory institutions? Too often, it is said by senior officials, well-intended, that according to the information provided by their own organization, that nothing is wrong, or that banks are exaggerating. But believe me, there is a significant proportion of inefficiency embedded in the current supervisory system. And I started with saying that you guys are doing a great job. Finally, the way banks organize and operationalize their business models should not lead to unfair regulatory consequences for financial institutions depending on the way how they are set up, even if the underlying risks are exactly the same. And in that perspective, I also support the call from the head of the UK Prudential Regulation Authority to simplify the capital requirements framework and to do away with an array of extra capital cautions, such as Pillar 2 add-ons by supervisors, capital conservation buffers, and countercyclical buffers. Now, how can we get forward? We all know that a piece of the puzzle of the European Banking Union is still missing. EDIS, European Deposit Insurance Schemes for bank deposits in the euro area. Currently, we still have different national deposit guarantee schemes, we all know, and this should be resolved by introducing that overarching European scheme, which then would provide a stronger and more uniform degree of a euro insurance cover, ensuring that the level of depositor confidence would not depend on the bank's location as a consequence on the member state. Therefore, we do regret that the Europe Group's recent initiative to revamp the project has been put on hold by the member states, and we hope, nonetheless, that further progress will be made in the near future. Now, although we are in favor of adding this essential third pillar to the banking union framework, let me raise a couple of intention points. First of all, I'm wondering what happens to the contributions that already have been made to national guarantee schemes, regardless if the local governments have set them aside in a separate fund or not. And this is, of course, not a message to you, but this is a message to other people as well. Will those funds be transferred to European level? Question mark. And we're talking about big amounts. Secondly, EDIS implies solidarity between all the banks of the banking union. That's why it's set up, although the difference in risk profiles between those financial institutions can still be quite significant. Hence, it is my opinion that solidarity cannot be achieved when there are no equal obligations in terms of capital requirements of risks that banks take. Particularly, for example, if the amount of bad loans is not cut by us below a certain threshold, or if sound profitability levels triggered by us are not achieved. So complementary to the banking union, it's paramount that we further step into the integration of European capital markets. Divergence in national regulations and taxation regimes hamper the creation of a European capital markets union. And we know that it is a patchwork of tax systems, indeed, in Europe. But strengthening a real banking union needs to have a more uniform financial or capital markets union. And today, European companies are disproportionately reliant on banking financing in comparison to the markets such as the USA. Now, the creation of a capital markets union would therefore provide an opportunity to balance the scale and lead to a healthier financing mix. And the definition of healthier, I leave up to your interpretation. As a side note, I would like to add that the much heard reference to the US capital markets as the ultimate final outcome for the EU does not take into account the specific setup and features of the different markets. Example giving, the regulatory context in Europe is completely different than the US capital markets. On top of this, the reality of financial services evolves quickly, and our regulatory supervisory framework needs to keep pace. New actors in the field of decentralized finance, digital currency, stablecoins, crypto, they are disrupting the financial services, and in order to maintain stability, supervisor regulators must take these into their scope, into their attention. Fortunately, awareness amongst regulators, supervisors, is rising, as illustrated by recent statements by the national supervisors, amongst which the ECB, amongst which also Fed, Bank of England, and I can continue. But we need to move faster. And if we would allow the new market players, to roam free, the risks of a new financial crisis would become much more imminent. Building upon this topic, I greatly support the ECB's effort in creating a digital euro, or what is then called the central bank digital currency. It's my strong belief that the current evolution towards digital money is inevitable, and it would be wise to acknowledge this by all of us. And I will repeat, us means including commercial banks. For good understanding, I'm not referring to the so-called stablecoins, but I'm really referring to digital money issued by central banks and having the legal status of money. In my view, central banks should take the lead into developing a digital currency, one that central banks control themselves. I would say one which allows to build an economy upon. Discussions on the position of the commercial banks in such a system is, of course, part of the debate, I agree. And let's say it differently, let's not drag our feet, because let's be clear, private players across the globe, big techs or not, will not hesitate to take the place of our monetary institutions when they are offered the opportunity. Nonetheless, we should remember that significant benefits that the banking union could deliver to European citizens. Like a chair, a different one than these ones in the room, but like a chair, the banking union needs each of its legs to be strong and balanced if it should be working as it should. Now, I have had the opportunity and the privilege to witness the unfolding of the EU banking union project from the front row as a CEO of KBC Group since 2012. A lot of achievements are a fact. And as I said, a lot of achievements can be qualified as good. But a lot of challenges are on the road in front of us. I realize, and I apologize in advance, that some of my comments may be highly critical on certain topics. But we, commercial banks and supervisors, are having the same interest. And in working together, better, on the level of equals, we will be able to tackle successfully the upcoming challenges to the benefit of the European consumer and corporate institutions. Thank you very much, ladies and gentlemen.
Thank you very much, Mr. Thijs. We have a couple of questions from our online audience, but first I'll see if there's any questions in the room. Any hands raised? I don't see any, so we'll give the preference to our online audience. So coming back to your remarks about fit and proper and acquisitions, what would be your proposals to make those processes lighter?
First of all, I said it's not an easy process, it's a complex process, and we have to the supervisors have to take into account a lot of measures. Obviously, you have a huge amount of difference in the different regulations, tax systems, and so on and so forth. But for the strict approval process, whereby I'm referring to not necessarily anti-competition, but the strict approval process of the ultimate ownership and so on and so forth. That process can be significantly speeded up. Definitely when financial institutions have been on in a recent time frame doing exactly same transactions, checks the same acquisitions, that process can be easily copied on the back of what was experienced 6 months, 8 months, 12 months, 20 months before. And you know, it looks perhaps exaggerated, but we're talking about processes which goes 9 months, 12 months. And in those circumstances, we need to be aware that the acquired assets, but I said it as well, the acquired staff, including the staff of the acquired entity, is under scrutiny. And sometimes the administrative process is too burdensome.
Thank you very much. Any questions in the room? Sophia?
Thanks a lot. Just one question. You mentioned integration as something that is needed, further integration. My question would be, given the regulatory framework, are the banks also leveraging as much as they can on the framework to move in that direction? Is there something more that you can also do with the current framework?
Now, I spoke on several occasions on integration. Which specific part are you referring to?
Financial integration, more cross-border activities, more European financial integration.
So I think indeed, let me first say something which is perhaps strictly personal and not necessarily shared by colleagues. I'm not convinced that big is always better, for good understanding. So in that perspective, integration, consolidation, and so on and so forth, yes, okay, but it needs to fit the purpose. So I'm personally more convinced that when it fits the purpose, and the purpose can be on different occasions strategic. I mean, the ultimate goal is to serve customers better and to have a stable financial institution so we can guarantee the long-term purpose, which I just said. So if it makes sense from a strategic perspective, it makes sense from a financial perspective, creating stability, income, profitability can be translated in higher capital ratios and higher returns ultimately to your shareholders, and then a good service to your customers. If all those boxes are ticked, consolidation makes sense. And in order to facilitate, and I assume the ECB, Europe in general, is indeed fostering the same position. If those boxes are ticked, the system should facilitate. Now, what's the system? The system is the regulatory part, the supervisory part for sure, but also the political part, also the tax system, and so on and so forth. And then within Europe, we have quite a lot of differences which hamper that. I touched upon one of them, that is how to protect the deposit policy of deposit holders. Within the European frame, this is fundamentally different. So if you go into a consolidation, often we are, as financial institutions, confronted with those differences which hamper integration.
Thank you very much. And maybe a last question. It's quite a broad question, but you mentioned you have been in the front seat watching the evolution of the banking union since its conception. So if you had a magic wand, what would you as a banker wish to see from politics and regulation for your industry and the consumer?
In brief, or I have in half an hour now?
You have brief.
I think, you know, and I'm twisting it from both angles. So I'm twisting it from the angle of a commercial institution, but also from the angle of a supervisor. Let's work better together. I think we all have the same goal. You know, we're on the same ship. And the same ship is providing financial services to fulfill customer needs. And if we understand good from both sides, what that means from our side, I mean, let's face it, we need to be able to generate capital so we create stability, so we can guarantee to our deposit holders and so on, that we will be there even in a moment of crisis. If we fully understand and grasp that position, and supervisors facilitate that in a very effective, also effective in terms of administration and so on, way of working, then I think we're both doing things together. So it's not they should, but it's we should.
Fantastic. Thank you very much, Mr. Thijs. Please thank the microphone.
Thank you.
Thank you very much. And now we will move on to our panel discussion this morning, Operational Resilience, Are Banks Prepared for the Worst? And don't forget, you can also follow the discussions on Twitter using the hashtag SRBECB2022. But now I'm happy to introduce our moderator, Raymond Frenken, financial journalist, and he will introduce his panel.
Thank you very much, Susan, and thank you very much for SRB and ECB for hosting this event, which I think it's the right moment, of course, 10 years after the introduction of banking union to take stock of where we are. In this panel, I hope we can elucidate you as audience on the operational resilience aspects and the challenges and opportunities that are still in there. The panel here is with Elena Carletti. She is a professor of finance at Bocconi University and also chair of the Internal Controls and Risk Committee at UniCredit, Italy's biggest bank, and that's a non-executive independent director role. Next to her, Christian Ossig, chair of the Bankenverband, the German Banking Association, and the chair of the Executive Committee of the European Banking Federation. And next to me is Fernando Restoy, chair of the Financial Stability Institute at the Bank for International Settlements in Basel. The institute was created, I believe, in 1997 after the Asian crisis, according to your website. And of course, we'll be joined online from New York by Elizabeth McCall, member of the Supervisory Board at the European Central Bank. Elizabeth, good morning to you. Very early in New York, we understand.
Good morning. Good morning. Thank you.
Good morning, yes. Before we start with the actual discussion, let's run a quick audience poll. Let's see what you as viewers, as audience, is actually believing are the biggest risks in terms of resilience. What are the chapters that you actually have identified? We'll be discussing some of those. Of course, there are aspects like the current framework, banking union, also technology and cybersecurity, and big tech as something that banks are increasingly reliant on, and of course emerging risks in the economic context that we are seeing at the moment, also with inflation and the context provided by the Ukraine war. So if you go to Mentimeter, you can answer the questions and see, let us know actually what you believe are the most challenging aspects and the most biggest opportunities. Climate change also among one of them. The ECB in the last few days actually ran a similar poll on Twitter, and the outcome of that one was actually that credit risk is seen as the biggest challenge in the area of operational resilience, next to bank profitability and cybersecurity. Now let's start the actual discussions over here. Elizabeth, let's first come to you. You've been very much working on the current framework that is in place. You have defined a number of supervisory priorities. Is the framework doing what it was supposed to do?
Thank you. And very interesting poll. I agree with some of the information that you've already put forward. And thank you for allowing me to join you virtually today. I had a personal family issue that has kept me from being with you. In terms of the supervisory priorities, we have a very important process at the ECB where we really spend time internally in each of our business areas. We spend time with the supervisory board. We spend time with each of the national competent authorities. And we gather, maybe it's right to use the word of polling process, where we really try to put our finger on where the risks are in the system and where we should be dedicating our resources in terms of our overall supervisory priorities. It's something that we do annually, but we have a forward look for a 3-year period of time. Interestingly, we just are going through the process in this week to check ourselves with the work that we did last year. And last year, when we put our priorities together for that 3-year horizon, we really had 3 things that we focused in on. The first was making sure that banks emerge from the pandemic healthy. And here, our big focus is really on credit risk and what's happening on the balance sheet of the banks. The second is, are the structural challenges that were there in the system even before the pandemic, are these structural challenges being managed? Are they being met? You know, when we went into the pandemic, we had certain issues with the banking institutions, such as sustainability of the business models and the profitability, ongoing profitability of the banks. And the third real area is emerging risks. Which emerging risks are out there that we need to be taking account of? And here we focus in on cybersecurity risk, the interconnectedness of the market and the rising interest rate environment that we're in, the kinds of things that can happen to the institutions as a result of the changing market environment. So these three areas we tested ourselves and said, as we began to emerge from the pandemic, of course, and appallingly, we are facing the war in Ukraine. And, this has had, of course, tremendous effect on lives of people. And it's something that we pray for peace. It is also having a tremendous effect on the overall marketplace. And so did this event, an ongoing event, has it changed our focus on supervisory priorities? In fact, it really underscored that the priorities we selected last year remain quite relevant. And in some ways, it made some of these priorities that we established even more relevant. For example, having a look at the changing interest rate environment, we're continuing to operate in an overall market environment that is experiencing a series of supply shocks and rising costs of food and commodities, which will have an impact on balance sheets and borrowing, et cetera. It also underscores the need for our banks to be focused in on cybersecurity risks, for example. It raises concerns that there may be increasing cyber attacks that we may see down the road. So yes, the answer to your question is, we're very focused on the supervisory priorities. We've validated that and made some slight changes in emphasis just this week in the supervisory board, and we're hard at work with our staff on making sure that we follow through on these in our supervisory program.
Liz, before we go to the rest of the panel, one specific question on the lessons learned. If there's one single biggest lesson that the ECB has learned in terms of working with these priorities, what is it?
I think that's a great question. The biggest lesson is that you should have a short view and a longer view, and not something that you just do annually with a blank sheet of paper. And why do I say that? The risk horizon is, of course, constantly changing, but it is not the case that you can deploy your resources to a changing environment for every single thing that you're doing on an annual basis. You have to have some continuity in the way that you are viewing the institutions, while also retaining an agility and nimbleness to shift as the markets shift. So I think the biggest lesson learned is to have a long-term, a 3-year horizon that we can operate in, and not just a single annual program. Some of the things that we need to be doing need to be done on a longer-term basis.
Thank you, Liz. Let's move to the Bank for International Settlements, to Fernando. You've in the past criticized the European structure for supervision, for resolution, and identified in one of your studies very significant shortcomings. That was a few years ago. Do you still see those shortcomings in the way it is implemented today?
Okay, of course, this is obviously a topic which is central to many of the discussions that we've had in this conference and in many other conferences and gatherings over the last few years, right? I think it's clear that the banking union was created not with a sort of wonderful ideological political motivation to try to foster additional European integration. Of course, it does contribute to European integration, but it was a defensive move, and we have actually to keep that in mind. I mean, we wanted badly to break this awfully perverse feedback loop between, sovereign risk and banking risk. That was needed, and that was the main motivation of the banking union when this was created. What we put in place is a fully effective, well-functioning banking union with a single supervisory mechanism, applying high homogeneous supervisory standards to all significant institutions in the currency union. We have a well-functioning single resolution mechanism that basically allows the resolution of, say, significant banks basically following common procedures, pretty much aligned with international standards on the matter, and also with the ability of making use of European funds, European fully mutualized funds, like a single resolution mechanism. So we have actually gone a long way in terms of sort of putting in place and developing this banking union concept, and therefore they have gone somewhere in terms of trying to reduce actually the chances for those perverse feedback loops. But the fact is that we are not yet there. This is clear. It is clear from the Eurogroup meeting last week. I mean, certainly there is no clear progress in completing the banking union. We don't have any reasonable prospect to have a European deposit insurance scheme in the forthcoming future. And what we have is basically some roadmap in the direction of trying to improve the crisis management framework. And this is relatively unfortunate, because for the banking union to make a good job in trying to mitigate sufficiently the risk of this feedback loop, perverse feedback loop, we really need the whole thing. We need actually single supervisory mechanism. We have a single resolution mechanism, but also we need actually a European deposit insurance scheme. On the top of that, certainly we have to improve the crisis management framework. Does not work properly. So right now, it's really a fact that most of the banking crises in the European Union will not be actually handled by the single resolution mechanism. We have to still rely on national mechanisms, national procedures, national rules, and we have to rely on national money. Again, it's something that goes against the very objectives of the currency union. And the same is true actually what respects integration. I think it's a key part of the equation as well. I mean, if we really want actually to sort of denationalize banks' risk, we need actually banks to be less national, becoming more European. So we need more pan-European banks. Whether large or small, we need them to be pan-European. And we have not made progress on that either. So whether you look at cross-border transactions, mergers and acquisitions, again, banks in Europe remain national. And this has to do with a number of things. It has to do with the structure of the banking industry in Europe, particularly in some large jurisdictions. It has to do with a number of elements there. But regulation is also important. The ring-fencing issue is there. That reduces incentives for banks to expand their businesses to other European countries. And this, again, this does not contribute actually to the ultimate goal, to provide sort of robustness to the European integration project. So we certainly actually need progress in those domains. Let's see if we manage actually to do it. But I'm afraid we don't have much time to waste on that. And the signs of fragmentation that we are observing in public debt markets recently, well, sort of is maybe as a signal that, again, we may not have that time, actually much time, in order to complete the job that we initiated.
Christian, question for you. As part of banking union, we have also a single resolution fund. By the end of 2024, banks will have placed 80 billion euros into that fund under supervision by the SRB. That's a commitment from the banking sector that they are contributing. When you then see the decision in Luxembourg last week by the Eurogroup ministers on banking union on going backwards or not making any progress on the deposit insurance system, how does that make the banking sector feel?
Thank you, Romain. And let me start by thanking the organizers for inviting me. And usually that's kind of a polite sentence that you say in the beginning, but I would like to combine that with a message. And that is clearly the banking industry, supervisors, head of resolution mechanism, we do not agree on all points. But it has to be said that the exchange of views, the dialogue, that works extremely well, that is of high quality, and that is important in times of crisis. Not only today, but also throughout the last years. So that is something positive I would like to start with. And if you allow one short personal note, Elena and myself, we go back a long time, over 20 years. Right. And over 20 years ago, we were affiliated to the Center for Financial Studies in Frankfurt. We would sit there in the audience and we would follow a debate like that with great interest. And it's fun to kind of change perspective and to sit today here on the other side. Yes. The question you asked, Fernando, kind of single resolution mechanism, where do we stand? And first of all, I think it has to be acknowledged that the SRB has done a great job in setting up that institution, building it, finding its place in the European supervisory landscape. And yet, you were asking about the funds that the SRB has collected, having that single resolution mechanism. No question there is a need for a resolution mechanism. We have to ask whether costs and benefits are in balance. I think you even mentioned the numbers. There are now 80 billion in the Single Resolution Fund. That takes a lot of financial substance away from the banking sector. And especially in these times where it's all about investment, providing funding for clients, you can ask whether Europe has gotten the balance right between collecting funds for a safety net and not harming too much banks' ability to provide funding. That is a question. Needless to say, I have a view on that, and some people here in the room have a different view on that. And that is something, I said at the beginning, we discuss very frequently and very lively. And the other point you brought up is banking union. I would like to start by saying that last week, from my perspective, and I'm speaking here for the European banking sector, that was a very bad day for Europe. It was not a surprising day. What we have seen there did not really come as a surprise, and yet it was a bad day and it's a disappointment. Why do I say that clearly? And I'm less about deposit insurance, the point you mentioned, and I'm less going on about risk weight of sovereign bonds or crisis management, these 3 or 4 buckets that were discussed there. When I say it was a bad day and is a disappointing day for Europe, I'm referring to the total lack of progress in terms of market integration. If we talk about banking union, for me, it should not be so much about EDIS. I understand that for some member states, it is a necessity to move on with market integration. That is even having a German hat on. As far as the private banks are concerned, I'm willing to compromise on EDIS. We don't need that. I'm not enthusiastic about it, but I see that there is a need to get done with it in order to progress in terms of market integration. Well, make a long story short, no surprise. In Donohue's work and projects, there was already weeks before the final meeting clear that there was not much on the table left in terms of market integration. That is very bad for Europe. We commissioned a study with Copenhagen Economics a couple of years ago. The benefits to really integrate European financial markets would be in the range of 100 billion per year. We talk about huge benefits that we do not realize. Now, how did this poor result come about of the Eurogroup there? We followed that all very closely. Germany was really focusing very much on getting exceptions for institutional protection schemes. Now, if you ask me if we want to have a level playing field, we cannot expect to exclude 20% of European deposits from a European deposit insurance. That does not work. We need to have less national options and discretions, less exceptions like do not touch on our institutional protection schemes. Germany has invested a lot of political capital on the question of risk weighting of sovereign bonds. Here you have a German position, you have an Italian position. For Italy, risk weight of sovereign bonds is complicated from the opposite perspective than from the German ones. Crisis management, especially for Italy, is a difficult topic. And I guess if I look at it from a French bank's perspective, I mentioned it, the Pillar 2 of banking union, hugely costly, not really a success story from the perspective especially of large French banks. I could say the same for large German banks. The appetite to have a third pillar is very muted. So bottom line, we have the result that we have, and that's clearly not a good result for Europe.
Elena, we heard Johan Thijs at KBC mention that his bank is required to report 6,000 reports to the supervisors as a result of banking union. We have the significant contributions to the resolution fund. Is banking union asking too much from the banking sector?
Well, first of all, good morning to everybody. And let me say, I'm speaking on my personal capacity, so I'm not here to do any advocacy or anything, just as a privilege, if you want, observers of also what's going on inside the banks. And let me say, I mean, the number of reports that banks produce for supervisor is indeed very high. And I think also part of it, what I think is a little bit frustrating is a part of the regulatory requirement are really a little bit of a nature of tick-the-box exercises, where I think, and this should not distract our attention, if you want, from the more core topics and issues that we should be focusing on. So rather than producing a lot of reports, I think what indeed I think it would be very useful is to concentrate on topics like scenario analysis, in particular in this current moment. What are the scenarios that we need to build? What are the scenarios that we have both for ICAP exercises on which supervisor base a lot of decisions, and as far as I understand, they are completely decentralized in a way they're not uniform across banks, from exercises more like stress tests where scenarios are instead given. But these, I think, are topics that we should be focusing much more, and also where the governance body should focus much more. Another aspect is now we have in the mid-reviews, we have the update of the scenario for the FSR 9. That's also another topic on which I think banks should be very concentrated, because this is the first time where possibly we are going to see changes in the way banks are incorporating the new shocks and the new situation with the Ukraine situation. And in terms of banking union, I mean, Christian said that he and I date back 20 years ago, but I think the banking union debates date indeed 10 years. And yesterday, I was a bit frustrated, I think, as everybody else, to see that it was exactly the same discussion we were having 10 years ago. I think Jean-Pierre yesterday mentioned, no, but between the risk sharing and risk reduction, we are not there anymore. That's not true. I mean, the fact that we haven't progressed on EDIs and probably regulatory requirement sovereign bonds is exactly because we are still back to 10 years ago in terms of risk sharing and risk reduction. Personally, I had hoped that COVID, the next generation EU, would have sort of helped in building trust and confidence among member states, and therefore it would be the basis for a renewed debate also on topics about the banking union. But I see that's not the case. Now, having said that, I want to say 2 points on the banking union. The first one is, I think, yes, we are focusing on EDIs, on resolution, but there is another aspect which I think has been mentioned before, which is integration in the ongoing concern basis, not just in the resolution phases. So I'm referring in particular on liquidity, capital movement. I mean, I live this in UniCredit, he lives in KBC. I think all cross-border banks live this. We cannot have cross-border groups and ask them to be formed and to operate efficiently if then on the other side, in their going concern, we have such a limitation to liquidity and capital. I mean, we have a single point of entry, and they should be completely consistent with this, also in life. And in terms of crisis management for medium institutions, let me echo a little bit Christian. I mean, I see what large banks are contributed in this moment. These are huge amounts. And what my request would be, let's make sure that the crisis management for medium banks doesn't translate into a moral hazard of medium bank versus the system, and in particular versus the larger banks.
Thank you for that. And before I put my next question to Elizabeth, let me remind you in the audience that you can ask questions. We'll reserve the final half hour of this debate actually for audience questions. Elizabeth, we heard some talk about the pressures on the banking sector, the 6,000 reports at KBC. What can the ECB do to sort of alleviate the administrative burden for banks?
Well, I think I think it's a common complaint that there are too many supervisory reports, and I think it's fair also to point out where supervisors, including the ECB, might be asking for the same information in different requests. So, we have a whole project that's quite focused on simplification, and we're really looking carefully at making sure that we're not asking for the same information in a credit risk review about the governance process, and then in the governance process asking for that same information, and not making sure that we link those things up. One of the things that I've just taken on at the ECB is the digital agenda for the SSM. And I can tell you that there's a great deal of development underway, transformation internally, if you will, across the users inside the ECB, but also with respect to the NCAs. There's a new project called Agora. It's a collaboration tool. And the idea is that as the data that we're receiving is growing exponentially by the day, and this is a common challenge shared by industry and by supervisors, are we able to see that we can link that data up and we can connect the dots, if you will? It will help us to be better supervisors. I think it will also help us to be far more efficient.
Let's move on to a different topic when we are talking about operational resilience, and that's technology. The emergence of big tech is clearly something that is becoming very significant for banking. We see that national regulators are providing instructions to the banking sector, to the financial sector in terms of outsourcing. And what we're really talking about also is about cloud banking, about moving the data in the bank away from the old server systems towards clouds that are often externally hosted. You're addressing a number of risks. Fernando, you are very concerned about this development. Why?
Well, I mean, it's obvious that we don't have to spend that much time on explaining the disruption that technological developments are creating in the market for financial services. I mean, this has to do not only with the evolution of the business models of banks themselves by relying much on technology, on outsourcing, but it's also we have new players, new providers of financial services, big tech, fintech, etc., and also you have the new business models like open finance or platform-based type of services, of decentralized finance more recently, right? So you have all these actual developments. A key aspect, which is the one you're referring to, is actually that also technology has increased the interdependencies between providers of technological services and the banks. The most popular example, of course, is the cloud, right? So cloud computing services provided by technological companies to financial, to regulated institutions, in addition to other actually activities that those big techs perform. Could be commercial activities or the direct provision of financial services to the public. So all these things, of course, basically constitutes a framework in which operational risk become really important. So it's time now actually to consider what should be the approach in relation to those enhanced operational risks. In the past, operational resilience was actually sort of addressed by different pieces, regulatory pieces here and there. We had to do with risk management, with business continuity management, sometimes with outsourcing as well. And now what we are seeing is that a number of authorities are going in the direction of putting together a more comprehensive, more holistic type of approach for operational resilience. And on that, I think two characteristics of these new frameworks, pretty much in line with the Basel Committee guidance on the matter. Two characteristics are, one is that they are pretty much firms-based. So the firms themselves, the ones who should actually identify the critical functions and services, the ones that should actually define their own tolerance levels, the ones that should test whether they're able to meet those tolerance levels, and the ones that should actually put in place a study to ensure that those tolerance levels will be met on a consistent basis. And well, is this enough? I see that the DORA approach in the European Union is somewhat different. It includes a number of more detailed, concrete rules that should actually follow by the firms themselves. Although the DORA, as you know, focuses very much on one aspect of operational risk, which is basically ICT type of risks. The second element is that the focus so far is quite micro or microprudential. So it's about how to actually strengthen, the resilience of individual banks by themselves. But we probably lack a little bit actually of more comprehensive overview of all interconnections between firms and technological providers of services to financial firms. I mean, just sort of hiring the services of a cloud service provider can be great for individual financial institution, can be economical, and can be effective from the point of view of operational resilience. But to the extent, of course, we have such a large concentration of CSPs, it's clear that disruption of one of the CSPs can create a huge systemic impact to the extent that basically all financial and non-financial firms, by the way, rely on the service provided by those few, actually, CSPs. And that's a problem. And we don't have yet a clear framework actually to address those more systemic issues, although the FSB, of course, is doing some work on that.
Do you see a specific role for Basel when it comes to managing these risks with cloud service providers in a global context? Yeah. Because quite often you have US firms.
Yeah, the context, I don't know what banking supervisors will be necessarily the ones actually looking at that. What we are seeing now is that in many jurisdictions, regulators rely very much on the due diligence by the firms themselves, maybe complemented by some requirements for the contracts, actually to include some audit rights for the firms and for their supervisors. This is more or less the approach which is prevailing in most jurisdictions. A different approach is the one actually foreseen in DORA, which is quite interesting and quite ambitious. It's about actually establishing, going to your question, establishing a specific regulatory and supervisory regime for those critical providers of technological services, even with some incredibly actually stringent requirement for those critical providers of financial or technological services to European firms to be incorporated actually in the European Union, which is quite an stringent approach. They are going that direction. To me, actually, this is absolutely warranted, and this is probably the approach we should actually follow, ideally at the global level, obviously. But going now to something you mentioned at the beginning. In any case, what we are missing, I believe, and this is what we have been writing about in the recent past, is about a comprehensive, actually, sort of regulatory regime for big techs which are active in the market for financial services. Right now, big techs are obviously subject to regulation to the extent that they have actually legal subsidiaries within the big tech groups which perform regulated activities, and therefore they need a license and they have to comply with different requirements, different sectoral requirements, for instance, in the area of actually operational resilience. But if you look at the big tech business model, there's a huge interconnection between the different subsidiaries performing different types of financial and non-financial services, including the cloud. They rely on common technological and data infrastructure. So simply this idea of going activity by activity and trying to monitor compliance with the sectoral requirements for each of the activities they perform does not make the trick. It is not sufficiently effective. You need a comprehensive, actually, sort of overview, comprehensive assessment of the operational risks that the operation of big techs actually generate, taking into account all those interdependencies. It's what we call that we need sort of an entity-based, group-wide approach.
Is that something that Basel is working on, something specifically?
It's something that BIS is working on right now, but basically with the purpose of facilitating a structured discussion about this important matter.
Yeah. I don't know, when you look at this from the perspective also from the Internal Controls and Risk Committee at UniCredit, how is ICT risk addressed over there? Is there a need for a more comprehensive regulatory approach to big tech in financial services?
Oh, yes. I mean, I think there is need for harmonization of regulation in general, regulatory approaches, so GDPR, DORA, they all have to be consistent with each other in order that so that banks can better operate within this framework and know what the policy is asking them to do. But then the control function need to adjust and to sort of incorporate all these new challenges into their risk frameworks. And this is not that easy. I mean, I think it was mentioned also yesterday in the last panel, I think banks are doing huge investment in this area, but they are not a very attractive places to work, even for people that are high-tech specialists. I mean, salaries and talent retention is an issue in these areas. Inflation is not helping in that respect because it may also exacerbate the difficulty of attracting and keeping these people. So it is a challenge, but I think they have first of all, the awareness that this is a path they have to undertake and they have to go with. I think I hear, I'm not a tech specialist, but I hear also my colleagues in the board are telling me clouds in itself is a very secure way of storing data and everything. So we may be worried with concentration, but it is a better system than others that we currently have. So in a way, it's a path that we have to undertake with the right attention.
So maybe cybersecurity and cloud banking are actually not separate topics within ICT, but go very well together.
Not at all. And it's important that it's strengthened both at, I wouldn't call it the first line, but it's more 1.5, we call it in UniCredit, because cybersecurity is not really first line of defense and it's not second, so it's 1.5. But then also the control function second line, they have to strengthen quite significantly. So we are relying on both of them for the way forward.
Cybersecurity came up as the top 3 risk in terms of operational resilience in banking in the ECB Twitter poll. Before we go back to Elizabeth, Christian, a quick chance to comment on this. Do you see a bigger risk in big tech and the dependence on that, or in cybersecurity?
Everybody here in the room knows that at some point in time there comes a moment where it makes click, and then you kind of feel you got it. As far as technology risks, cyber operational risks is concerned, when Mark Branson started as the head of the German Supervisory Authority, my first meeting with him, he was sitting there and he said, Christian, for me, operational technology risks, they're just as important as microprudential topics. Now, he was speaking to someone that spent 10 years thinking about Basel implementation, all these things. I was kind of amazed. I was kind of thinking, how can he say that? Now, you might think, Christian, you were rather late in understanding that. Looking back, I would agree with you. Especially when I spoke to US supervisors, policymakers, bankers, I always had the impression they did not want to talk anymore about microprudential things already for many years. I wanted to talk about microprudential. They wanted to talk about technology, operational risk, etc., much long before I was there. And today I'm there, and I'm glad to tell you that European banks were much faster than me realizing that, and Elena was just referring, there is a huge amount of investment attention going into that. And by the way, also at the European Banking Federation, we have understood that. We have a small handful of strategic committees where we really bring together the key issues that we are focusing on. And of course, Gonzalo from the European Banking Federation is here. He's in charge of the microprudential supervisory topics. We have now one for operational technology risks as well. Now, what does it mean in a European context? And you were referring to outsourcing, cloud, etc. We need to outsource banks. That's our future. Cloud is our future. We need to have frameworks where we can work in and operate properly. I'm not too sure that we have that sorted out yet. That's a discussion we are still having. Level playing field, looking towards technology providers, especially large technology providers. Here in Brussels, very often when it comes to legislation for technology firms, I have the impression that Brussels likes to look at the technology sector kind of as thinking there are a lot of only thousands of fintechs that need a lot of support here. And that is also the regulation that I see emerging a lot, is a regulation where I feel this is a regulation that should help smaller technology firms to develop. It's not really a regulation that properly captures the risk that is emerging from very large technology providers, where the question is valid to think, do they need to be supervised? Maybe similar to the way banks are looked at these days. I think that is a very important question, both from a stability as well as from a level playing field competition perspective. Now you were asking cyber risk, etc. When the war of aggression, Russia-Ukraine started, we banks were all very worried. We expected now a wave of cyber attacks coming, etc. And Andrea could report to that. But from what I gather from the European banking sector, we haven't really seen an increase there. Look, we are all waiting, and I don't mean that in a positive sense, for the big accident to happen. We have not really seen that yet, and banks are working hard to avoid that, but it is a topic that we all are we feel we are well prepared, but we are fearful of the risks out there, yes.
At the beginning of the year, we saw financial regulators across Europe remind institutions that they need to make sure that the cybersecurity aspects are properly addressed, also in the Russia context. When you look at the ECB, I know the ECB is also nudging and encouraging banks to make sure that those systems are properly protected. Elizabeth, are banks sufficiently resilient in the area of cybersecurity?
Well, first of all, let me validate my fellow panelists on the need to be focusing in on this technology aspect and the need to be focusing in on the security component, and also validate, Christian, your comments about Mark Branson, and also the top of mind concern that supervisors have about resilience in the context of, let me just say broadly speaking, technology, and that covers a wide variety of things. It covers the cybersecurity issues. It covers outsourcing arrangements. It covers concentration issues that all need to be looked at in this way. It's true that our expectations going into this war were really raised on concerns about cyber risks, and it's also true that so far, we haven't observed an enormous uptick in cyber attacks, but that doesn't mean that we should be, by any stretch of the imagination, complacent in any way. So we're placing a lot of importance on protection measures. We're asking institutions to establish and test their response and their recovery mechanisms, and we're asking them to make sure that they're adapting to an evolving threat situation. So a number of institutions engage, it's common, third-party providers for IT-related services and infrastructure. It's essential that they adequately manage and oversee the outsourcing arrangements that they have in place, that they have a deep understanding of the underlying risks, that they ensure ongoing service availability, and that they strengthen operational resilience. And they need to be focused also on concentration risk. I'll give you an example. Coming from the pandemic, there was an institution, I won't name any institutions, obviously, but an institution that we supervise had, for strategic reasons, outsourced IT activities to some consultancy firms that were operating in India over the last years, and they had dedicated facilities in India. And of course, they were looking to use a lower cost environment and reduce physical and logical security risks, et cetera. But India was hit very hard by the pandemic, and there were very restrictive lockdown measures that were put in place. And of course, staff became unavailable from one day to the next, and even to the point where you couldn't reach some of these employees by phone. And the bank then had to move some of its operations back to Europe, and at the same time, relax some of its security standards to allow the staff based in India to work outside designated facilities, et cetera. So these were good responses. But what it led to in the end was around 6 months of delay in the overall transformation of the bank's program. And it also meant that the bank was assuming increased security risks for more than a year. So the lesson here is about potential consequences of an over-reliance on third parties and also concentration. So I think, institutions are taking a harder look at concentration risk and their third-party arrangements. In the area of cybersecurity, I'd also like to give you an example. And here, we have strong guidelines in place already. The guidelines that have been established by the EBA on external ICT and security risks outline some fundamental things that, if they are followed through, can help strengthen the resilience of an institution. We did a horizontal analysis last year, and we saw that about a quarter of the banks still have gaps in the area of looking at their IT asset inventory. So this January, there was a major cybersecurity event that was identified. It was known as the Log4j, and it was very highly covered by the media. This vulnerability was a software flaw in a library that was extensively used for web applications and for other software. And a key step for remediating this vulnerability and mitigating the risk is to understand which systems are using that library. So what we found is a number of institutions had significant difficulties in identifying the system. And this demonstrates why it's important to have a current and a complete asset inventory for timely identification of systems that become impacted by known vulnerabilities. So I wanted to give a couple of concrete examples of some of the risks that are out there and some of the things that banks are working on to improve resilience.
Well, thank you very much for that. Very interesting. Now let's move on to one of my favorite topics, credit risk. We see the financial markets that have actually suffered quite badly so far this year. Unlike previous years, lots of concern about the performance in the economy as a result of the Russia war against Ukraine. We have rising inflation, increasing worries over corporate earnings expectations now also becoming part of this context. And when you look at the poll, the Twitter poll by the ECB, credit risk emerged clearly with 40% of the voters as the top risk for the banking sector in terms of resilience. Now, we saw during the COVID pandemic that bankruptcies actually did not exist because of all the support to the economy from the government programs, the conducive behavior also by in terms of monetary policy by the central bank. And you can imagine that we're moving into a completely different scenario. Are banks prepared for a new rise in bankruptcies, a new rise maybe in non-performing loans, the context of increasing challenges in terms of counterparty credit risk in general? Fernando, can I ask you about that?
I guess probably the panel is Elizabeth, the one who could be in a better position just basically to speak about what is the situation of banks themselves. I basically agree very much the way you describe the situation. We were all quite concerned about the impact of the discontinuation of these support measures, how this would affect actually the quality of banks' portfolio. So far, what we see is that there is no much of a problem there. I mean, I was speaking to a banker last week, and he was telling me actually that the default rates actually for those loans that were subject to this sort of a moratoria, and now they are going back to the normal calendar, are exactly actually the same as the other loans which were not subject to this. So basically no impact so far. Whether there is something hidden, it's hard to say. Certainly it's hard to say for me. Maybe Elizabeth has a different view about that. What is clear in any case is that these important support measures have worked to bridge this very specific situation, very concentrated in time. That is clear. And that's contributed massively actually to keep both economic and financial stability. That said, my main concern now is probably about the implications of those support measures on the sustainability of public finances in the European countries that in a context of higher interest rates is obviously contributing to these signs of fragmentation that we are observing. And that's obviously the main risk that we have to face now at the macro level. And eventually, of course, this could have implications for banks themselves.
Elena, do you see credit risk as something that could cause trouble in the future?
Well, I mean, of course, is the answer. But I think now we are at a level of uncertainty still. As Fernando said, we have not seen that much so far. That is a bit difficult to predict. But let me say there are pros and cons. The pros is that credit risk, differently from cyber risk, is the core of banking and the core of banking risks. So in a way, risk management framework and also capacity within banks to deal with credit risk are certainly there. And therefore, from this perspective, they are better equipped, the banks are better equipped. Now, having said that, this is a different type of credit risk. It's a little bit similar to the one we saw with COVID. And why am I saying that? Because normally credit risk is, the assessment and the management is based on time series, past information. But with the COVID, we already learned that what is really important is more forward-looking analysis, because these are exogenous shocks that come into the system in a way that past creditworthiness is not an indicator necessarily of future creditworthiness. So what our banks are required to do is really to develop this forward-looking analysis that they have already been doing during the COVID pandemic, but there it was more a sector analysis, if you want, and now is almost name-by-name analysis. So the challenge is going even more granular than in the past with the credit analysis. And that, I think, is a challenge. Now, if we look at direct exposure of the banking sector towards a sector or companies that rely massively on energy, I think I saw ECB studies recently showing that direct exposure is less than 2%, so it's very little. But of course, what's very difficult is to estimate the indirect exposure and the indirect effect that may come from it. And here, granularity, again, is essential. And I was looking recently at an OECD study that I found very interesting. It was a study on the impact of energy costs on individuals. And it was very interesting to see how granular it was going. So they were dividing between home energy costs and transport energy costs. They were dividing between middle, high, and low-income household, living in rural area or living in metropolitan city, because of course all these elements impact enormously on the impact that increased energy costs will have on the household. So this is just an example of granularity that we are having.
Christian, when we go back to the crisis in 2007, 2008, the European sector, the European economy wasn't really as exposed until it became clear that the domino effect from the Lehman collapse would affect the European banking sector. And that's ultimately, when you trace it down in history, that's what triggered banking union as a response in terms of policy here in Europe. That was an unexpected crisis. People now getting worried about the economy, about getting credit risk possibly collapses down the line somewhere, more talk about recession in the US. Is that, how is the banking sector taking in that risk?
2007, 2008, that is very far behind us, and we have a very fundamental difference here. Banks have more than doubled their capital ratio. That was quite a painful path, but it was the right way to go, and that is, and I will come to that in a second, but I would say that you asked Fernando, are banks well prepared? I could always ask back, well prepared for what? Right? We could think of very different scenario here. But I would say as far as kind of even what the ECB would call a worst case scenario in a stress test world, banks are prepared. Kind of your question, credit risk, macro, there are two dimensions for me to answer that. And let me start with the question on stability. I want to be very clear. The challenges here are, first of all, unlike in the financial crisis, a challenge for our clients. And this situation is very difficult because it's a number of different crises that are actually interconnected, lying on top of each other. And I could think of inflation here, global supply chains there, etc. It's a very complex situation if you look at it from the perspective of a risk manager in a bank when he looks at his clients right now. Elena said we have learned a lot from the pandemic. That's right, but the situation now is in one aspect fundamentally different. The pandemic always was clear to all of us, it's temporary.
Yeah.
So we had to answer a question, how do we get through this dip? Now, when I even speak to some of my banks on European levels, I get answers that are the right answers to fix something that is temporary. We could discuss with supervisors, do we need more moratoria, etc. But we all know the situation now is not temporary. We're going to stick with high energy prices and all that entails for quite a while. That is why we need different answers now than we had to give during the pandemic, a pandemic that we are not over with now. But my main message is here, banks are prepared to cope from a financial stability perspective, what we would call a worst case scenario out there. But of course, if we would stop all Russian gas supplies from our side, from the Russian side, today things could get worse, and then we need to revisit that situation. I would like to put also spend a few sentences on the second dimension here. The challenge is not only to manage risks and stability. The challenge also is that there are high expectations on the role banks now have to fulfill to fund the economy. Why am I bringing up that point? Because all the challenges, all the risks we are talking about today, they at the end, and it is counterintuitive, but if there is one prognosis for me for the decade ahead, it will be a decade of investment. We need to sort out our global supply chains. We need to sort out how to stop climate change, etc. So credit risk challenges, but at the same time, banks are under huge pressure to finance the economy. And now we could come up with different numbers, etc. Now banks have done well during the pandemic to be at the side of their clients, to fund them throughout the pandemic years. I cannot sit here and be as confident as I was during the pandemic for the challenges that I had. I'm very confident as far as stability is concerned. Banks will always be able to fulfill their capital ratios, etc. But are banks today well prepared to cope with the funding challenge ahead? I'm not so sure. I see that bank capital to respond to client needs is already a shortage today, and we have not even seen the big funding needs coming our way. In Germany, I see a lot of funding needs coming from the restructuring of supply chains, because a lot of even SMEs now, we might not like that, but they have understood that they need to relocate production facilities into the EU, maybe even to Germany, and they go to their bank and say, I need funding for that investment. And for banks, it's not very easy today to respond to all these funding needs. So when we talk about credit risk, the challenge that we need to get right here is, yes, we want to have a stable financial system. I want to have a stable financial system, but we also need to be able, in this crisis we have, to provide funding. Now, I understand that when I speak to supervisors, their incentive is to make sure that there is sufficient capital for stability. And then I speak to politicians, and it's their role to voice that there is sufficient capability and capital available, that banks can fulfill these expectations as far as funding is concerned. We are more at the beginning of this debate than at the end of this debate.
Very important point you're making, Christian, on the need to finance the transition. The transition, of course, in terms of energy sources, but also in terms of climate change. And that requires significant investments. We need capital markets union for that as well, of course. But when you look at that need, Elizabeth, in the context of the current economy, banking supervision, the whole system that we have in Europe, banking union, very much is focused on financial stability. Do you see much room to let banks actually finance that transition? And basically the question is, how is the ECB from the Euro Tower, the ECB supervisors, how are you viewing this economic change that we are seeing with inflation, possibly a recession?
Thank you for the question. Again, I'm going to find myself agreeing very much with my fellow panelists on the different risks that they see out there. But I want to maybe bring a little bit of a sharper focus on a couple of the issues. And it's right to draw the trajectory from the pandemic and the credit risk scenario that we saw in the pandemic, and how very well managed this picture really is as we look at the balance sheets of banks. We benefited tremendously from global cooperation, from fiscal supports, monetary policy supports, supervisory measures that really allowed for that temporary situation to be managed in quite an excellent way, with far fewer bankruptcies existing now than I think any of us would have predicted at the outset. Fast forward to today, where we're facing an exogenous shock in the form of the war that is also exacerbating the continued supply chain issues that were already there from the pandemic. And lay that against the macro picture that I think we need to really be focused in on, which is the banking environment has changed quite dramatically. What do I mean by that? We have a situation where the shadow banking market has grown exponentially in the last decade. We see new entrants into the lending to the overall economy that exists. We see that in not an insignificant way. There is a tremendous shift to lending that's taking place to the overall market from private equity, for example. And one of the concerns, I would say significant concerns, that I would personally have is about what the impact of that is on the overall credit quality in borrowers. So, for example, the leveraged finance market has also grown exponentially in the last decade. And you're seeing that there's a huge shift toward what's called covenant light. But even more than covenant light, a concern that I would raise is about the negative pledge that is now de facto a market component driven by the private equity firms, where leveraged borrowers previously had constraints on their borrowing capacity imposed by affirmative covenants by the banks that they wouldn't borrow above a certain threshold. Well, the private equity firms have made a requirement that that be dropped. So now, do we have complete line of sight into what the overall leveraged ratios look like? Do we understand very clearly what risk exists in that marketplace? All of this piece is happening, of course, in a market that's marked by a constellation of risks. I mentioned the supply chain. My colleagues on the panel have mentioned the rising energy costs, the derivative impacts that has on manufacturing and business, and what will occur there. And of course, concerns about the flow of gas being reduced quite tremendously. What will be the impact of that on an overall basis? So we continue to have concerns about counterparty credit risk in a wide variety of ways. And I think it's really important that we make sure that institutions do have that name-by-name look-through credit analysis and very strong credit risk management processes in place in the banks. Now, you also ask about the transition, and it's of course the case that there's got to be a pivot in Europe to other types of energy that may not be so climate friendly in the very near term. But in the longer term, what this brings into very sharp relief is the need for Europe to move its climate agenda ahead even more quickly. And it's also true, Christian is saying this, that the funding needs that are there are going to grow exponential, not only in the area of financing the transition for climate change, but also in the funding needs that are necessary for technology transformation. So we're very fortunate that we entered into the pandemic because of the great efforts of folks that came before me to strengthen the capital ratios in the institutions, to strengthen the risk management practices in the bank, and to put the banks on a very sound financial footing going into the pandemic. It's going to be very important that we continue that strength so we have sustainable ability to fund the economy on a going forward basis. And we have to be very cognizant of some deepening risks that exist out there.
Elizabeth, when you mention concern at the ECB over this counterparty credit risk in this current context, should we expect any specific steps from ECB supervisors towards banks on this?
I think you will hear us continue on a bank-by-bank basis to be very actively engaged in dialogue with the institutions to improve their risk management practices.
Thank you. Christian.
Do you mind, Raymond, if I just quickly, one thought on what Elizabeth said on leverage lending, because it's a good example on how difficult it is to get the balance right between stability on the one hand and banks' ability to fund the economy. That the ECB looks at classical leverage finance, PE-driven transactions, I understand. Now, if the ECB comes up with a definition of leverage finance that suddenly not only captures PE-driven transactions, but that is, in a way, so we like clear and simple rules, but if they are so simple that suddenly a large part of the European corporate world falls under leverage finance, companies that have received, for example, state lending, state support measures in the pandemic. Now, if I look at the ECB definition of leverage finance and I see how that applies to the client world, I find a long list of companies, corporates, that have nothing to do with traditional leverage finance. For me, what Elizabeth, and she brought that up, is a good example which shows that the question of stability on the one hand and ability to provide funding to pretty ordinary European corporates is not an easy task.
Does the ECB need to look at different factors to assess leverage?
The ECB knows that, and we European banks talk to them a lot about that. As far as leverage finance is concerned, we think they should take a different approach there.
If I may, I think this is a discussion on the definition of leverage transaction that I also hear a lot internally in the bank. And I do agree with Christian. I think the ECB should make clear what a leverage transaction is and possibly go for a definition that doesn't incorporate also lending to highly indebted corporates, because otherwise it's really becoming, I mean, I speak now countries like Italy, but also as a result of the pandemic. I mean, we know that corporate indebtedness has increased. If we now incorporate that into the definition of leverage transaction, we really risk to cut a big part of the corporates from what banks can do. So that is an issue that I know Andrea personally is very concerned with, that is very dear to him, the definition of a leverage transaction. But I think it's an area where indeed what Christian is saying between stability and on the other hand, lending and supporting the economy is the core. And I think there is scope for some clarification at least of what we really mean with leverage transaction.
Very interesting to hear this. I also see this in my work in covering the asset management industry. And asset managers are looking at their investments, their portfolios, and they're saying the traditional rules for assessing corporates do not apply anymore. We're in a completely new constellation where you need to look at different factors, different ratios than what you've looked at in the past. Fernando, I see you're taking notes, but it seems to me that we may be facing a risk that we are driving into the future and looking into the rearview mirror.
Should it be otherwise? I mean, so basically we have to certainly look at the future, look at the challenges that the financial industry has to face, the contribution the financial industry should actually make to the huge transformation of the economy. But, let's not forget about the experience that how relevant is to keep actually sound financial system, that at the end of the day, there is no real trade-off between the stability and the continuation of credit flows to the real economy. That of course there could be some adjustments here and there, that obviously could be some disproportionate requirements that could actually have unintended effects. Supervisors, international sensitive bodies are continuously reviewing actually those rules to see whether these unintended effects are relevant or not. But let's not accept as a proposition that there is a trade-off actually that we have to face. There is no way in which the banking sector can contribute to the real economy. It faces some difficulties to remain stable and sound.
I want to go back to Elizabeth one more time on these issues, because from what I understand from Elena and Christian here is that it sounds almost as if the cockpit screen in the plane that the ECB is driving is a little bit outdated. Elizabeth, would you agree with such an assessment?
I wouldn't agree that it's outdated, not at all. And I think in a way we're all in this together, and Fernando is exactly right. I don't think there's a trade-off at all between sound credit risk management and financial stability and ensuring that institutions are there for lending to the overall economy. And you use the phrase rear view mirror, and I could only smile a little bit about that because, of course, we always need to be taking on board the lessons of history. And the last time that we allowed leveraged finance to grow in an uncontrolled way in the subprime crisis, well, we all know what happened. So I think what is extremely important is to be exquisitely clear about a changing market environment, about understanding that lending to borrowers that are not going to be able to pay at the end of the day is something that is only going to hurt the overall economy, just to speak very simply.
Thanks for that.
Can I make another example?
Sure.
Because Fernando says there is no conflict between stability and ability to lend. And leave the ECB aside for a moment, look more in a national context. Macroprudential supervision. I'm talking about Germany. We have just activated, it's going to be really put into force only next year, but there is a counter-cyclical couple buffer and a sector-specific measure for the real estate market. 2% additional capital requirements for real estate lending. Now, what world are we living in at the moment? We see that because of inflation, house prices stay where they are, extremely high. And we live in a world where interest rates rise, and because of the sector-specific measure for real estate residential lending in Germany, their rise particularly, the increase is particularly strong for residential real estate. Now what is happening in a world where buying real estate is super expensive already, and in the past years, normal people had access to purchasing real estate because financing was low. Now suddenly you have not only high prices, but you have prohibitive high financing costs. And that excludes large parts of the population, the Mittelstand, from acquiring real estate. Now, I would call there is a conflict here.
No, I mean, policy is about conflicts and trade-offs and compromises. You have to make different objectives. That's clear. I'm not saying that there is no trade-offs at all in policy action. Quite the contrary. It's actually, sort of day-to-day business actually for policymakers. I was referring to something very concrete. And I qualify myself in saying something like over the medium-term principle, there should be no trade-off between financial stability and sort of adequate flow of credit to the real economy. Because an unstable financial system is unable actually to support the real economy on a sustainable basis. The example you were referring to is a different thing. And this is a very interesting one, right? Which is, you have a macroprudential tool. By the way, this macroprudential tool, some macroprudential tools that certainly affect the affordability of housing for some segments of the population are particularly effective, actually, in order to moderate disorderly, actually, developments in credit or in housing prices. We know that. And it's a good lesson, again, with your rear mirror, a good lesson, actually, from the crisis. In my own country, in other countries, right? You have a huge credit boom, huge housing price boom, that the disorderly sort of correction of that just triggered a disastrous, actually, financial instability episode. So we have identified a number of macroprudential tools that could be helpful in particular to prevent those episodes and therefore to preserve financial stability. Does it mean that it's a completely free lunch? Of course not. Of course not. At the end of the day, because you introduce this type of measures, certain skills, as you said, that could affect the affordability of housing for some segments of the population. What is the response to that? Well, if you have two objectives, find a second instrument. But let's not compromise, actually, the application of helpful, effective macroprudential tools to preserve financial stability, which is a hugely important public good, I think.
May I just add one comment?
Sure, Elena.
I think, if I now take my academic hat for a moment, I think, in order there is that trade-off between financial stability and growth. In normal times, we should see financial stability as almost an intermediate objective to foster growth. So in a way, it's true, there shouldn't be any trade-off between financial stability and growth. Having said that, the reality is a bit different and depends also a little bit on what economic condition one has. So macroprudential tools are normally introduced in times of booms of exuberance. And therefore, the support to the economy is different than a situation where as we have now, where inflation, for example, is supply-driven, is not demand-driven. So here we don't really have an exuberance in terms of economy. So in this situation, I think the trade-off may be a little bit more subtle. In a sense, here we're in a situation where, on the one hand, we want to keep the financial system stable, but on the other hand, the economy is not in a boom moment, or at least it was a little bit, and now we are starting again into less of a boom situation, to be optimistic. So that, I think the trade-off is a bit different. So here is a situation where regulation also should maybe sit back a little bit and think, okay, how am I still pursuing financial stability, but not in an excessive manner, because indeed the support to the economy may be more relevant than when we are introducing a macro-pro where there is exuberance. So it's a bit different, the situation. I think we have to put it in context.
Yeah. So that, I like the way you put the issue, frankly. And also it allows us actually to discuss something which I think is relevant. We have actually faced the pandemic shock in particular, right? So the new regulatory framework put in place after the great financial crisis has been tested. This new regulatory framework introduced important reforms on the microprudential domain, is the Basel III, so on. Certainly the resolution domain is the sort of new resolution framework that has been put in place at the global level, but also macroprudential framework for the first time. So sort of sensible reflection here is about whether that macroprudential framework has worked as expected. And we have some interesting lessons. We don't have time to cover them in full, but some interesting lessons. For instance, in terms of those macroprudential buffers, you mentioned the countercyclical capital buffer before, capital conservation buffer, etc. Have they worked as we expected them to work? And the answer is probably not quite. And something has to be done in order to actually sort of mitigate the type of conflicts that you were referring to. So accumulate actually buffers in good times then release them in bad times in order to maintain your normal flows of credit to the real economy. And that's the way you should actually sort of approach this trade-off. It really exists, but you have actually the possibility to design tools in order to cope with it. And there is something to be reflected on that, of course.
And the buffers, of course, to a certain extent, are there already in the banking union. I'd like to bring in a related question from the audience, maybe not completely on this interesting field of tension, but it's a question to Christian. We must indeed invest, but on so many fronts. Does the banking sector have the capacity to cover it all? Do we need priorities?
The banking sector has the ambition to be on the side of our clients and to fulfill all these funding needs. And really, they are substantial. The Commission thinks 400 billion per year for fighting climate change. And I mentioned to you kind of the restructuring of global supply chains from this moving away from just in time to just in case. It's not sustainable. So there is a lot going on. Now, I could, a very senior German banking supervisor, this time not from BaFin, but the most senior Bundesbank, he kind of talks to me regularly and he says, oh, you know, I doubt the bank's ability to really deliver on funding that. And he says, we need to look more at the non-banking sector, etc. And I'm very unhappy with, it brings me back to Fernando and Elena, your answer was perfect, kind of looking at what is the link between stability and growth, etc. Right now, I feel left, right, and center this conflict. Also, when a banking supervisor looks at me and says, "Oh, you banks, you cannot really properly, adequately respond to all these needs there. That's why we need to look at more the ability of the non-banking sector." And you can imagine how I feel about that, because I'm kind of thinking, now the banking supervisor kind of, this is shadow banks, right? The activity that should be regulated has moved to some other lenders, and the supervisor kind of thinks about how can we better mobilize them. I would like the supervisor to think how he can better enable banks. And if I may leave one thought with you, Fernando, the real estate sector in Germany never experienced any crisis. So we are now killing, and it's also a social question here. We are restricting access of the vast majority of the population to buying real estate. That is bringing a lot of other political risk also with it that we need to take into account in order to preserve something that I understand from a supervisor's perspective is good, which means always more capital in a bank's balance sheet.
Would it help the European banking sector if the policymakers in Brussels would step up capital markets union? Because that's also designed to increase diversity in the funding landscape in Europe.
Everybody here in the room would agree capital markets union is an answer to a lot of the challenges we're facing, but we also know that we talk about capital market union for decades. There has been very little progress, and that is not because policymakers don't get it, that is because progress is difficult. My advice would be, and I'm not a policymaker, and that is sometimes easier than being one, my advice would be let's focus on things where we really can make a big progress, but that are also feasible. Harmonizing insolvency frameworks in Europe, that is quite a challenging task. It's going to take many years. Securitization, that is the one area where I would say, let's make sure we get that solved properly. We haven't done so in the past. I also understand that from a parliament's political perspective, just the term securitization on the back of the crisis is a difficult one. And if I sit here now and explain the world that it's actually synthetic securitization that is a real solution, then I know that in the European Parliament, I'm not going to get a lot of applause for that. But frankly, when we talk about capital markets union, let's be pragmatic. Let's focus on what's feasible, what has a huge impact. A lot what we discuss now has to do with capital. So let's try to get assets off banks' balance sheets. Let's create investable assets for investors that live in an inflation world, right? Let's create a really practical, competitive securitization framework in Europe. What we have right now is not up to this.
Elena, do you see room for the EU to accelerate capital markets union?
Well, if we have to judge as well, we are making progress in the banking union. I wouldn't be that
let me ask
optimistic.
it in this new geopolitical context that we find ourselves. Is that a new window of opportunity?
Well, perhaps. I mean, we also discussed yesterday, Europe advances when there are crises. And, for example, during COVID, I think we have made huge increases and improvement in terms of cooperation. So possibly, yes. I mean, possibly Europe will realize that now the needs are such that we need further progress in capital market union.
Now we have about 10 minutes to go, and I mentioned the poll several times throughout the discussion, and it actually was the results of the ECB Twitter poll. But we've had our own poll running out in the last hour, and I understand from the team, I have a message on the iPad here, that poll is ready. Now let's see what the audience response to that poll was. In which area do you feel banks are least resistant? And that's the red one. The economic context is a challenge, and then climate change and sustainable finance. And then we have a second question on which area do you feel the banks are most resistant? And again, but with fewer votes, the economic context. And interesting to see here compliance and AML, anti-money laundering and KYC as something that banks have invested in quite a bit. Now, indeed, the economic context is also flagged by the audience in the poll as something that is very important. I'd like to do a final tour de table, and feel free to also bring in any elements that have not yet been discussed so far. And I want to start with you, Fernando.
Well, we have covered much ground, probably too much. So we couldn't get really deep into specific issues. But let me just go back to the very first issue we discussed, which is about actually the banking union, what the prospects actually just to improve the banking union, to complete and improve the banking union. I think it was Elena saying, and I pretty much sympathize with what you said when said that, well, we have been actually a number of years discussing this issue. I sit here, I listen to the arguments, they are not very different to the ones actually I could hear so many years ago. And you're absolutely right. In the area of improving the crisis management framework in Europe, it's very clear, right? I mean, we started discussing these issues about, the mid-sized banks and about actually the lack of an EDIS and the need actually to put in place actually mechanisms to deal with the crisis of different types of banks already for many years, and actually don't find new ideas. But if I want to be positive, and I want to be positive for once now, we have achieved something, which is there is now relative consensus on the issues. So we know what are the problems. Not only that, I see also that there are some sort of ideas of what should be actually sort of the main reference in order to solve some of the issues that we have identified on which we agree. For instance, I think it was Elke mentioning yesterday at some point that some years ago, the people who were actually involved in the analysis of this type of situation, the failure, the flaws of the crisis management economy in Europe, hesitated very much to use the term we have to go in the direction of European FDIC. This is no longer the case. I mean, now the term European FDIC is actually used by everyone, which is great, because European FDIC is basically sort of a list of ingredients that you are able to develop could actually help sort of solving some of the issues that we are looking at in Europe. So the good positive side of all this is precisely that. Some agreement on diagnosis and some agreement on some of the elements of a solution, which is something. My main problem is that as we are making this relatively moderate progress, I mean, time is running out. That we have this tension in the public debt markets, that the risk of more fragmentation, the risk of an eventual reactivation of the feedback loop between the sovereign and banks, all those risks are now more significant than some years ago. And the issue, of course, whether actually we can have the luxury just to wait to get additional concrete progress in implementing the solutions, and not only about sort of agreeing analytically on what the problems we need to solve.
So clear awareness needed on the fact that time is limited, for us. Elena, your final thoughts?
Well, there are many aspects that we haven't touched. One is clear, but let me put it under one umbrella, which is I think it's important that both banks and the regulators have as much clarity as possible on whatever we're discussing. We didn't touch much, but one area is, for example, climate risk. That's an area where banks are required to do a lot of things. But there are, again, these differences between what's the role of banks, and possibly there shouldn't be any, but what's the role of bank in fostering investment, and in particular energy transition, and on the other hand, what's the role of banks in risk managing, in managing the risk related to climate and environment. And there, I think, there has to be clarity as to what the regulation is coming up, and there has to be also, if you want, flexibility from regulator and supervisor in terms of understanding the situation now may not be the same as it was 3 months ago. So what banks should be doing now and how we think about gas or even coal may be different from how we were thinking about this a few months ago. So the first point is clarity from the regulator and supervisory perspective as much as possible. Second, I think banks want to be guided. So when you said before to Christian, do we have priorities in what banks should be doing? I think banks need guidance as to what they should be doing. And I think one aspect that the supervisor may be doing that would be very useful for banks is to share best practices as much as possible. So to make clear that banks understand the expectation, but really concretely, not just in more general terms, because banks would, I think, then invest in the right direction. Knowing already what is the best practice. And it's not just a matter of avoiding bad practices or worse practices. It's really trying to give incentives to the banks to become always better in whatever they do, governance, risk management, business model, whatever they do. And finally, we heard before the ban to dividends. We were in a situation in the pandemic where we had so much uncertainty that it was very different to differentiate across banks, and this is why, this was one of the motivations why we had dividend bans. Now we are still in a situation of high uncertainty, possibly different, possibly even worse, but to some extent, I think it would be important to distinguish across banks, and not to make all banks look alike, because ultimately we want champions, we want the banking sector to remain strong, and if we, maybe for excessive prudence or for uncertainty reason, we tend to penalize even the better ones, then we risk to homogenize the system to a extent which wouldn't be optimal in my view.
Christian, would you take guidance from the ECB on where to invest?
No, not on where to, well, this is not that.
On best practices.
On best practice.
Yeah.
Take a lot of guidance from ECB, very smart people, and very challenging, but as I said, the dialogue is highly valued as an association, but mostly I get that from our banks. Very quickly, the poll, there were a couple of things that we did not discuss. Couple of things that surprised me. Well, it surprised me. I liked to see that people believe AML risk is something that banks control really nicely, and I hope that the audience is right. I see banks making a lot of effort. Risks that banks do not control after the economic macro topics, climate. July 8, Elizabeth, Andrea, and the team, they're going to present the climate stress test of the ECB. My expectation is a bottom line. And what is it based on? We have seen Bank of England presenting their results. That material risks are not so high coming from climate stresses. It's an important exercise that we do. The ECB always says it's learning together. And yes, we are learning together. I would be very surprised if we see kind of in terms of materiality, something that would confirm this poll, like saying climate risk is an issue that could bring the banking sector to its knees. We have not seen that with the Bank of England. I don't see that with my banks. I would be surprised if the ECB would see that. And by the way, the comments that we have heard, I think it was 2 days ago from Frank Alderson on the climate stress test, would confirm that. I think the headline was, banks have made a lot of progress. He probably wouldn't say that if the ECB would believe it is one of the major risks that might bring the banking sector to its knees. Dividend ban, we had long discussions with the ECB on this back then. Also there, the dialogue was very good. The ECB came about with restrictions, and the banking sector said it's the wrong tool. I don't think that's a tool that is at all on the table in the current environment. I would hope so. My last point, and that is not new, that's going back to the beginning, Europe, market integration. Elena said before, Europe is strong in times of crisis. That was my expectations 4 months ago. Sean Berrigan, coming back from the discussions of the first sanction package, he said, Christian, great momentum. Europe, on a very difficult topic, is showing ability to act. And high hopes that this ability to act we might transpose to other fields like banking union, financial integration. 4 months later, in our field, Europe has proven no ability to act whatsoever. Big disappointment. Fernando said before, oh, we lack these cross-border banks. My answer to that is very simple. There is no rationale today for banks to be active in a cross-border context. You can run separate institutions with one supervisor, but the economies of scale are very limited. It's not a new topic in terms of our debate today, but we need to make that our top priority, I find.
Elizabeth, final thoughts from you? I think there's plenty to connect to.
Yes, definitely. Thank you. The first thing I'd like to say is, and I'm summing up this panel that we're in this very broad-ranging discussion. The first point is banks are resilient. There are a number of reasons why that's the case. There was a tremendous coordination and cooperation across all of the different sectors of the overall government structure globally, and the banks themselves and what they have done to strengthen their balance sheets. We're in a situation where the banks are resilient. The second point is I have this little bit of a sense of history here as we think about what the constellation of risks looks like, and it feels very uncertain. There are a number of indicators there that are telling us that the risk situation in the overall global marketplace is at a heightened level, so heightened that we probably haven't seen this level of risk that is developing out there in quite some time. So it means that we need to be very vigilant about risk management processes, financial stability, and ensuring that the institutions remain resilient. The third point I'd like to make is I'd like to strongly add my voice to everyone here in expressing extreme disappointment on the lack of progress on the banking union. I had the sense when, 4 months ago, when this war broke out, that and watching history taking place with a unifying element occurring across Europe in a way that no one could have predicted. Everyone would have thought it would take decades to bring about this level of unification. I expected that level of unification would translate into deepening the banking union and setting up the structures that we need to make sure that we have a safer and sounder European banking system, to make sure that cross-border can take place, to make sure that we have a safety net of an EDIS in place, and to make sure that we have a strengthened capital markets union. So I guess I urge all of those who have a voice to continue to work on that, because as Fernando said, it's extremely important at this uncertain moment, which is characterized by so much risk. The last point, and it's a much smaller point, and it's just about the securitization market. I recently saw a statistic out there. In 2008, I think, and including the UK, 75%, the European securitization market was 75% of that of the US. In 2020, with the same statistic, it is 6%. Securitization, if appropriate significant risk transfer takes place, can be a way of mitigating risk on the balance sheets of the banks, a very powerful way. You can homogenize the risk and you can distribute it to an overall marketplace. And development in that area would also help us quite a lot in this moment of incredible storm gathering clouds. Thank you.
Thank you very much, Elizabeth. And thank you very much, everybody else in the panels, for a fascinating discussion. I hand it back to Susan.
Thank you very much, Raymond, and to you and the whole panel for such an interesting and wide-ranging discussion. Unfortunately, we're nearly coming to the close of our first ever joint ECB-SRB conference, but I, for one, hope it won't be the last. But let me invite SRB Chair Elke Koenig to give us some closing words. Elke.
Thank you very much, Susan. Good morning. I think it's still good morning, yes. So it falls on me to close this event, and after such a rich discussion, I'm not sure where to start, where to end, without partially repeating. But let me first of all thank all of our participants, those who spoke yesterday and today, those who asked very interesting questions, and those who simply listened, and of course also the media representative, and last but not least, the team that prepared this so flawless. This is not in my speech because the team did not think I should thank them, obviously. Banking Union, 10 years on. I think first of all I would start with the old statement. We have a banking union. We have a single supervisor. We have a single resolution authority for the banking union. And of course, yes, we are all disappointed, but let's not be overwhelmed by our disappointment from last week, because I think what happened last week was clearly we would have liked to see more progress in the area of the third leg. EDIS will clearly for now have to take a back seat as some other topics, but there was also good progress in some of the areas of crisis management, and let's now put all our efforts into developing this. So, just to use a simple phrase, we are where we are. No need to talk about the spoiled milk. Let's move forward and let's see that we really promote the crisis management. And I think I want to take this opportunity again to truly thank Pascal Donahoe and his team for all the effort they have put in pushing forward the banking union. And let's take the positive part out of last week's discussion. There is a clear momentum to move forward, not as fast as we would have liked, but let's see. And to go into this direction, I think just to state, improvement or improving the crisis management framework, I think it's fair to say, and the word came on in today's very interesting panel a lot of times, there is something which we didn't have 10 years ago. There is a strong sense of communication, cooperation between authorities, cross-border. There are the European authorities. And I think it's also fair to say that Banco Popular in 2017 and Sberbank this year were cases that proved that the resolution framework in Europe is working. Now you can always say, but what if? But let's start from, we have a resolution framework, it's working, and of course there's more that needs to happen. And I think, Andrea, you put very nice words yesterday out in your opening speech. I would say both cases, all the day-to-day work shows that the strong cooperation between supervisory and resolution authorities, don't forget there were not even any resolution authorities 10 years ago, is really helpful, and also the very good cooperation and to make it with the banking industry. We are in this together. It's not for us to make banks resolvable because we know it all. It is for us in dialogue with you so that you can focus on the topics. And I would a bit counter your comment. I'm a strong believer in benchmarking, but not in benchmarking to make everyone the same, but in benchmarking to try to find good practice which can trigger further debate and therefore make things even better. So it's not about the one European bank. But I think what we have to see is clearly when we look into, now call it the next years, and I've strong made a plea always whenever you have a project, look for the next 2 years, don't look for the next 10 years because it's just an excuse not to start this year. So for the next 2 years, I would, or for this cycle, I would indeed turn to the details of the Eurogroup outcome last week. And the statement clearly spells out 2 things we would strongly support. Expanding the scope of resolution, so to focus really on the fact that a bank either gets resolved or it moves into insolvency. And there might be this famous middle class, which probably better gets resolved. It's a bit too big to go into insolvency, perhaps a bit too small to be really already caught by our system. But for this expansion has to be accompanied by an enhanced set of funding options for the resolution authority to ensure that we really have all the tools necessary for the resolution of small and medium-sized banks, and for sure in a fair setting. So it's not for the big ones, they are caught by the full armory of our tools, and the small ones go into insolvency, and then there's a layer that goes for free in between. No, we are in a competitive environment, so there needs to be funding options that are consistent. I won't go into detail, otherwise we are here for a couple of hours. Therefore, but as a logical consequence, we also welcome the plans to strengthen at least the national DGSs. It's important to reinforce depositor guarantee systems across the banking union to provide reassurance to depositors, but it's also important to have them in a consistent system where, well, same rules apply, which goes to the question of alternative measures, which you need if you want to have a resolution, which also goes to the question, what's the least cost? It's not the total amount of deposits. It should not be zero either, but it might be zero because of super priority of DGSs. So a lot of work that has to go into all of this. And to stay with this, I also hope that we will see some work, because it's inherently connected, on harmonizing insolvency procedures, at least for financial institutions, because a lot of practical steps. I'm not a dreamer, so I'm not expecting that we come to an administrative insolvency procedure right away. But as it was also mentioned today, a European FDIC should still be on the horizon. Now, I could go on with a number of other topics here, but let me try to come somehow to a more, I would say, the challenges we are all facing. And I found it fascinating, thank you for the organizers here, to say we talked a lot, and I think we're licking our wounds during the first panel about the banking union and where we stand. Then the second panel, I got the feeling, will be for my grandchildren to explain to me what I have to do when we talk about banking in 2040. I'm optimist. I will hopefully still be there, but I might watch it rather from another, will definitely watch it from another place. But also the discussion we had to do today here. I think we all need to see that banking union was developed in the beginning in record speed. I've never seen an EU project that went so fast into working. Well, it takes us still to implement it, but it has to stand the test of time. But I think we also have to reiterate, banking union, capital market union, despite big data, all those discussions, stay very relevant, stay important for a sound European economy and the funding of a sound European economy. So let's all keep pushing there. The pace of change, advance of digital technologies, fintechs, all of this should not be overlooked. But I am probably at that point a bit older and get the feeling I'm always going back in all these debates, also some of the topics of today, to the Pittsburgh statement. Same business, same risk, same rules. And I think we should not forget about it. Of course, you need consistent, stable market finance. But the backside of that is shadow banking. So same risk, same rules. I would just go back to this argument. And of course, in the end, it will be for people other than me to deal with all of this. But it is something we need to keep in mind there is much hard work on the road ahead in order to get the balance right between allowing space for innovation, being creative, not to fight the last war, not to consider you've seen it all and you know how the world has to run, and at the same time ensuring that we have a proper, up-to-date regulatory framework in order to ensure that we can deal with any hiccups, and to take your point, that we hopefully also get focused in a way that we are not repeating the same question in 5 versions within 4 weeks, but that we are trying also to use this good cooperation we have to ensure that if data is available at the ECB, well, it's available for us too. If data is necessary here, let's try to find the smartest way how to get to this. I could go on for long with this, but I think you have addressed so many topics also during this last panel that I am very happy to see. We will not run out of steam. We will not run out of work. And I leave it just and want to conclude. I think we are all aware of the context in which we meet today. And so in a time of diversion, in a time of big uncertainty, I think it's essential that we come together in the spirit of cooperation in order to drive financial stability agenda forward. It is more needed than ever. And when looking at the poll, the economic environment is probably far more uncertain than it has been for a long time. And there was one risk which was not mentioned, which I think is mattering too. For most people in this room, it's probably the first time that we see rising inflation, that we see political tensions building up. We have been living in a world where basically a number of risks had been rather declining. So let's deal with the fact the world is an uncertain place and we have to make the best out of it. So this was the first such ECB joint conference and my last, but I hope it's a good example for that cooperation, and I'm pretty sure we are all taking a lot of ideas, a lot of thoughts with us, and it will not be the last of these conferences. So, and therefore, let me say goodbye now to all of those connected online. Thank you for connecting, and to those who've made it here to Brussels, I thank you also for this effort. It's good, it feels good to talk to real people again in a room, and when clapping hands, it doesn't just sound like one lonely warrior in a room. So thank you for all of you, and I wish you now a safe trip home, but I know that Susan has still some other instructions.
Thank you. Thank you very much, Chair. Just before we officially end, please note that the recordings of the event will be made available on the SRB and ECB website, so you could relive it all again. On behalf of the whole ECB and SRB teams, a warm thanks to all of our speakers and moderators over the last 2 days, and especially to you in the audience for your active participation. From the SRB building here in Brussels and all of us in the room, goodbye.